We just have a quick question here from Tumelo asking whether they should close a trade before we have a major news event coming up. So thanks for this question, Tumelo. The answer is a little bit tricky because it really does depend on a couple of variables too, actually. The first one is what type of event you are waiting for. So if it's just a low expectation event, something like, in today's session was a good example. We had CPI for three major economies. We had CPI for the UK, the EU, as well as the CAD. But given the current sentiment, these were really low expectation events in terms of the outcome. So if it's these types of low expectation events, then you could consider taking a trade in the morning, maybe even before the event. If it's scheduled in the afternoon. However, if it's a highly anticipated and more important event like a very important central bank meeting or a highly anticipated economic data point, then you're probably going to be better off waiting for the event to play out before you take a trade, unless of course you are planning to trade into the event. But if that is the case, then arguably you would have already been in the trade way before that. Also keep in mind that US data will of course be important for all the currencies because the dollar is so important. Major events for the US might affect something like the Aussie yen, for example. If it's a good enough, if it has a big enough impact in terms of the overall risk flow. So definitely something just to keep in mind. So the type of events very important. And if you want to know which events are highly anticipated every single day, then you really don't need to go much further than the terminal because we provide that info every day in the terminal in our daily risk event outlook report. So these daily risk event outlook reports, it'll show you, whether there are any very important events coming up, and will prepare you on which things to look for and which things to expect from these events. Of course, we also run through them through the day in our video commentary as well as the daily video webinars. Now, what about those events that might be market moving, but they are not expected to move the market? So, as traders, like these CPIs we had today, as traders, we need to be aware of these upcoming events, during the day and how they might impact the markets. Even if we don't think it's going to have a massive impact, we need to be prepared in the case that it does have an impact, coming in with a very huge deviation. So let's take yesterday's retail sales as a good example. So let's open up our risk event report from yesterday for retail sales. Now, we highlighted retail sales yesterday as the main economic data point for that day. And here we can see that we highlighted it, or we hinted that a beat above the market's maximum expectation would feed into the risk on flows that we had in yesterday's session prior to the event. And if we just quickly take a look at the retail sales numbers, how they actually came in, they came in way above the market's maximum expectation. We had that big jump to the upside, that V-shaped recovery looking chart. And that is exactly that we highlighted as a potential thing to watch out for, is any type of V-shaped looking rebound could spark further risk on flows. And of course, if we just look over to the equity markets in yesterday's session, that move to the upside, that spike to the upside that we had was on the back of that retail sales data. Now, yes, it was short-lived because directly after that, we had the new case numbers coming out, and that saw some downside in the equities. But if we didn't have the case numbers basically spoiling that outlook, that would have seen further moves to the upside in terms of risk sentiment. So in the example of retail sales, it's not like we expected the numbers to come in way above the market's maximum expectations, right? We didn't expect it to print at these massive numbers. There was no way of knowing how the data will come in ahead of time. But rather, the important thing is that we were prepared for it if it did happen. So always be prepared and have a game plan, in case it does deviate substantially. The second variable to consider, apart from the type of event, is the type of trade that you're taking. So whether it's a scalp, an intraday trade, whether it's a swing trade. If it's a swing trade, then waiting for the important event might be good if the event has the potential to change your entire macro fundamental bias, like, a central bank meeting. But if it's a data point that might not, it might cause some volatility, but it won't necessarily change the overall bias, like today's CPI events, for example. In this current context, these ones shouldn't have been a game changer for you to take a swing trade, for example. If it's a day trade, again, it's going to come down to the type of event that you're trading. When you're facing major events, rather keep your powder dry. like if it's NFP, like tomorrow, for example, we have the BOE coming up in the London session. So ahead of that, right now, where we're sitting, getting closer to the end of the London session, I'm probably not going to look for a trade on the pound right now until we get that BOE meeting tomorrow, unless there's something substantially that happens between now and before the event in terms of Brexit. To keep in mind. So if it's a day trade, rather keep your powder dry. If it's a major event, if it's not going to be a major one, like retail sales, it was an important one to keep in mind yesterday. But again, we didn't have expectations for it to reach that level. If it did, obviously we had a game plan for it to jump on it and trade it accordingly. But if it's just like CPIs for today, it would have been fine to open a day trade even in the morning, waiting for these events to transpire. So yesterday, for example, we had those risk on flows after retail sales beat way above market's expectations. But we also highlighted in our videos, apart from the daily events, we needed to watch out for that second wave case number. So apart from just these scheduled events, we'll also go through the potential unscheduled events that we need to watch out for. That can obviously also be important on whether you should or shouldn't take any trade. So it's always just be mindful of those variables. What type of events are coming up? What type of trade you're looking to trade, and that should give you an idea of whether it's good to rather stay out of the market or close a trade before you reach or head into those economic data points or main events like a central bank meeting. So I hope that helps with your question, Tumelo. It really does come down to those two variables. But if there's any other questions, please don't hesitate to let us know.